Okay, sorry about that. My machine decided to go slow at the wrong moment. Again, welcome to this presentation. Just a quick reminder for those who have just come into the meeting to put questions in the chat function on Teams, and we'll get back to those towards the end of the presentation. And again, if you could keep yourself on mute, that would be helpful. And also just a note that this is being recorded, and hopefully we'll be able to circulate that recording later on today or on Monday. What we definitely will be able to circulate later is the slides with the notes on the presentation. So inevitably, economic activity in Europe collapsed somewhat in the face of COVID-19, as you can see from this chart. Most of what I show you will be data about the European Union, simply because that's the biggest block that we have data for as a block, although there will be information about other countries and specific as we go through the presentation. You could also see that there was a very strong recovery in the third quarter of 2020, which actually means that the recession, although very steep and very deep, was the shortest it can possibly be. Definitely a recession being defined as 2 consecutive quarters of non-positive growth. And that's a pattern that was repeated across most of Europe. These charts on a slightly different basis, they measure the percentage change compared to a year earlier, effectively the annual rate of GDP growth or decline in the various countries. You can see here the 5 largest economies, which have varying rates of decline. Unfortunately, the lines get a bit tangled up in the latest period because pretty much everybody had the same experience. Perhaps most notably, though, is the fall in Germany, which was broadly half that of particularly the United Kingdom and Spain, which are the green and the red lines. But France, Italy also have had very large falls in GDP. Just bear in mind the chart, the axis, the y-axis, the vertical axis on this chart. You'll notice that this version of it starts at around about -21. Which was the UK and Spain's fall in GDP. As we move on to the other countries, you can see that the chart starts much higher up, only at -15. So although it appears that Austria and Belgium, which are the 2 countries on this chart, had a very steep fall in GDP. Indeed, they did have a very steep fall in GDP. It wasn't on the same scale as we saw in particularly, as I say, Spain and the UK. One or two issues around how particularly government output is measured, but we won't go into those at this point. We don't have any Q3 data yet for either Switzerland or Finland, but we would expect to see recoveries in those 2 countries. One other thing about Finland is to note that the fall in GDP compared to a year ago in Finland was only about -6%, one of the smallest falls that we've seen, that we'll see across the countries. And the final chart, which brings together the last 5 of the countries that we're covering in this presentation. The only country here that we have Q3 data for is Sweden, so we haven't yet seen the recoveries, but I'm sure they will be there in those other countries. Again, notice the y-axis on this chart is broadly the same as the previous one, indicating that Hungary, which is the worst country, if you like, on this particular chart, is not on the scale that we saw, particularly for Spain and the UK. Unemployment inevitably has been rising through 2020. Although evidence suggesting it might be falling again slightly in the latest month or 2 worth of data. But it is slightly misleading. Many countries have government funded schemes to support jobs, Different countries have done it in different ways, but they all have essentially the same objective, which is to support jobs. Indeed, some countries actually have a law that bans making people redundant, and that will inevitably be suppressing the rate of unemployment. So although we can see on this chart that it looks as though we've yet to see the current scenario play out fully, of course, but it looks as though unemployment isn't going to rise as high as we saw in the financial crisis, 2009. Unemployment always runs a little behind economic activity, and let alone the rates we reached in the euro crisis in 2013. Although it looks as though we haven't seen those rates, the underlying picture may well be much higher, although we probably may not see it in the data because of these policies. Inflation has fallen back to the sorts of levels that we saw in 2015, particularly for the euro area. The EU as a whole, inflation is a little bit higher. You can see from the bottom of these two charts, countries like Poland and Hungary and the Czech Republic, Czechia, which aren't part of the euro, of course, mean that the average inflation rate for the European Union as a whole is much higher, or quite a bit higher than it is for the EU, for the euro area, where you've got countries like Germany, obviously, and Spain, which have got actually negative inflation at the moment. And the euro has been strengthening against the US dollar and the Japanese yen, less so against the Swiss franc, and of course the rate against the UK pound is, well, at the moment changing almost hourly, depending on what markets perceive the negotiations around Brexit being. I will come back and towards the end of the presentation say a little bit about Brexit, breaking my rule, if you like, of not talking about specific countries. But I think it's such an important subject that you probably all want to know about it anyway. And government debt levels inevitably have risen. This chart shows the rates in 2019 and then the rates for the second quarter of 2020. It will take some time. I mean, the debt to GDP ratio will build continuously. That's while it's leapt up initially, it will continue to build for some time. The most dramatic picture is in fact in the deficit to GDP ratio chart in the bottom right, where you can see government spending as a share of GDP has shot up, most notably in the UK, where we've had to let it fall off the bottom of the chart, really, otherwise you won't see some of the other figures, some of the other countries' figures very clearly at all. And we don't have any data for Italy or Spain for the second quarter of 2020, which is why they're not on the red coloured chart. Looking at the economic sentiment indicator, which the European Commission publishes, the ESI as a whole is a whole economy measure. So it looks at activity for across 5 sectors and combines those into a single indicator. You can see that fell. We're looking at the blue line on this chart, fell to roughly the sorts of levels we saw in 2009, the early part of 2009, but then recovered more quickly than in the previous recession. It's a function of how this current crisis has come about, and I'll say a bit more about that in a moment. But the last couple of months, interestingly, looks to be tailing off again. This really is a reflection of the depression in confidence in the service sector and in retail trade, which of course are affected by the restrictions on face-to-face interaction in society, and that means that this current recession has affected the service sector much more than it did in the previous recession, in the financial crisis, or indeed the euro crisis in 2012-2013. And while industry confidence is weak, industry is the red line on this chart. You can see that actually industry has done less badly. It's not right to call industry, say industry has done well, because it clearly hasn't, but industry, which is the red line on this chart, has suffered a smaller fall in confidence, particularly compared to the service sector, and hasn't shared in the latest downturn that we've seen. If you look at the blue line and the black line and the green line, which are services, consumers and retail trade respectively, you can see that's where the downturn in confidence has come over the last couple of months. This chart goes up to October, over those last couple of months, and you can see that industry, it's flattened off actually. The red line kind of disappears at the very end, but so industries not seeing the latest downturn, at least yet. We'll have to wait and see whether that what happens there. Interestingly, in the latest data from the Purchasing Managers Index, we've seen a bit of a diversion between what's happened in most of the world, actually, not just Europe, but between specifically the Eurozone countries, really, on the whole. You can see here this general chart, which just tracks the Eurozone PMI. You can see, although it's still well above 50, just a little bit of a downturn in the last couple of months. And that's not something, as we'll see in a moment, that we've seen in other countries. This shows 7 Eurozone countries. I'm sort of thinking we probably ought to take a couple of them off to make the chart a bit more readable, but it's not sure which ones to take off. Maybe Ireland can go, not sure one will help. But anyway, a couple of notable things about this. The Purchasing Managers Index in the Eurozone had actually been quite weak through most of 2019. Most of the Eurozone countries that are tracked were below 50, in fact, through 2019, long before we'd even heard of COVID, let alone before it had happened. And most notably Germany, which is the black line on this chart. So Germany in particular, Purchasing Managers Index, and these are for manufacturing only, so they're not whole economy, was weak for some time. And you can see almost everywhere had a very sharp fall in the Purchasing Managers Index for manufacturing. Netherlands, interestingly, not so bad. Again, not great, but not so bad as maybe the rest. And in the current recovery, it's notable that Germany is now leading the way. You'll all be aware, obviously, that Germany is by far the biggest economy, particularly when it comes to manufacturing in the Eurozone, indeed in Europe as a whole. And therefore, that's potentially good news that the Purchasing Managers Index in Germany is very strong. Bigger economies don't tend to have such a big movement in PMI very often. So the fact that Germany's PMI is up around 58 is potentially a good sign, as long as it doesn't fall back. Just looking at some of the other European countries, I haven't actually got the UK on one of these charts, but the UK's PMI in November was up slightly, as it was, as you can see, in countries like Hungary and Czech Republic, Czechia and Sweden, and also in Switzerland, which is on the right-hand chart. The two countries where it was weakest in Europe, apart from the Eurozone ones we've already talked about, were Turkey and Russia, which you can also see on the right-hand chart. Indeed, in this particular region, Russia is the only country where the Purchasing Managers Index, the latest reading, is below 50. I should perhaps have pointed out on this chart that the November reading saw France and Spain edge just below 50. They're only just below 50, but nonetheless psychologically important that they're below that crucial 50 level. Capacity utilisation has recovered some of the ground that it lost after the initial impact of the coronavirus outbreak. Interestingly, here again, to compare with what's happened in previous recessions. So nothing like the Eurozone crisis, which is here. Similar sorts of levels to what we saw in the financial crisis in 2009, when the impact of that really struck. But again, notice a much steeper V than we saw just over a decade ago in that previous recession. This compares the capacity utilisation measures in the Eurozone, the European Union countries, and is really there just to make my usual point that you can't compare necessarily capacity utilisation rates between countries. You can't say, oh, it's 80 in Germany and 70 in Italy, therefore capacity utilisation is much stronger in Italy than it is in Germany. In Germany than it is in Italy. And a good illustration of this on this particular chart actually comes in these two countries here. So this is Belgium, BE is Belgium, and you can see that the capacity utilisation rate in the latest reading for Belgium is well into the bottom half of the range of readings that you see in Belgium. Next to it is Bulgaria, and you can see that the capacity utilisation rate in Bulgaria is lower than it is in Belgium. But for Bulgaria, it's actually in the top half of its range of values since the year 2000, which is a lot of readings. That's 20 years. That's 80 odd readings of the capacity utilisation. So really, what you have to say is that capacity utilisation in Bulgaria is actually probably slightly better than it is in Belgium, simply because you need to look at where countries are on their own scales. Having said that, I'm now going to break my rule and compare capacity utilisation rates, but only bend the rule, not break it, because I want you to focus across this chart and look at where the individual countries are in relation to themselves. So again, don't compare the UK and Italy with Germany and Spain. Look at where those countries are amongst themselves. So doing that, you can see that the capacity utilisation rate in the UK and Italy's kind of buried under the UK line here, unfortunately, are much lower than they were in the previous recession. Similarly for France, which is the blue line, you can compare where they were. Germany and Spain, in contrast, capacity utilisation only fell to the sorts of levels that we saw in the previous financial crisis. So what I want us to take away from this particular chart is the fact that capacity utilisation, while it fell everywhere inevitably, wasn't so bad in Germany and Spain as it was particularly in France and the UK, and to some extent Italy. I mean, Italy had a larger fall in the previous recession, but nonetheless Italy was still below where it was in the financial crisis. I'm not going to spend a lot of time on this chart. The data in this has got a bit distorted by various factors, but suffice to say that particularly the investment picture doesn't look very good, certainly in the Eurozone. What is of perhaps more use is a survey that the European Commission does twice a year, looking at industrial investment expectations, and these are the figures for 2020. So we have 3 surveys that give a view of 2020. One from last year, the end of 2019, again, before we'd even heard of COVID. One from this spring, which is the red bars, and one from a month or so ago, which is the green bars. We will get one more reading of investment next spring, which will effectively be the data. So where did the outcome turn out? And that will be added to this chart then. What you can see on this is inevitably a major weakening of investment expectations in the spring, and generally, although there are a couple of exceptions, another significant weakening of investment expectations in the latest survey. Inevitably, when the spring survey was carried out, we were just in the opening phases of the coronavirus outbreak, and some of the restrictions in some countries hadn't really been even put in place. So inevitably we saw a further weakening by the time we get to the autumn. Two exceptions, interestingly, are the Netherlands and Spain, where the autumn reading is slightly less pessimistic than the spring 2020 level. But it's worth noting that in spring 2020, those two countries had by far the weakest expectations. So perhaps, you know, the respondents in those countries were a little better at anticipating the crisis. Nonetheless, there's still very weak investment expectations for 2020. For 2021, we only have one data point, which was the autumn 2020 survey carried out about a month ago. And you can see here, most countries expect a modest recovery, very modest recovery, given the declines that we're likely to see in 2020. Belgium, ever the optimists, expecting a very strong bounce back. As with 2020, I expect that to be moderated when we get to the next survey. And Italy and the Netherlands particularly, perhaps, but Italy and the Netherlands expecting a further fall in industrial investment in 2021, which is pretty pessimistic. It's hard to see a scenario where it's going to fall again unless there's something specific in the data, but we shall have to see. Turning now to output, so we've looked at the investment and the whole economy, and investment really is obviously a major driver for machine sales. We have a lot more data about industrial output, and industrial output will be particularly useful for those of you involved in the tooling business. If people are making things out of metal, then they're going to need tooling. They're not necessarily going to need a new machine, but they're definitely going to need tooling. So let's take a look at output. We saw a very sharp fall, obviously, between March and May, although it had been on a generally downward trend, as you can see, through most of 2019. Nothing dramatic, but not exactly positive picture. A lot of these charts have been ruined by the current recession. You can't see some of the small movements that took place in history. But we see the very sharp decline in March, April and May, followed by a recovery. Although again, as with some of the other figures we've already seen, it does look to have been a levelling off in the last couple of months of data. It remains to be seen whether that's temporary pause, or whether activity will pick up again. And particularly in the euro area, it actually looks as though the latest reading, which is for September in this series, actually fell slightly, which is a little bit worrying in some respects. We need to go into a little bit more detail, of course, because total manufacturing covers lots of things that aren't relevant at all to our industry. Food and drink production, for example, chemicals industry. You don't sell many machine tools into the chemicals industry. One or two here and there, but not many on the whole. But if we look at capital goods, which is very much where machine tools manufacturing technology is sold, that's where most of it goes into within manufacturing. You can see that the capital goods output fell more sharply than total manufacturing output fell in the downturn in the spring. This is quarterly data again, so the really weak period here is the second quarter of 2020, and then has recovered to some extent, at least, in the second quarter, the third quarter, which is the latest data. Again, levels of the sorts of levels that we saw in the financial crisis in 2009-10. But a much stronger, much steeper recovery, although it remains to be seen whether that recovery goes on, but nonetheless a much shorter hit to output levels. I'm going to take a look at some of the key industries now, one by one. But first of all, an overview, if you like, of the four main industries where manufacturing technology equipment will be sold: automotive, machinery, which is sometimes called mechanical engineering, a wide range of things in machinery. Similarly, metal products, quite a broad category, although it does include a lot of the subcontract activity, what the Americans call job shops. They're in the metal products group, if you like. And then on this particular chart, other transport equipment, which is mostly aerospace. We don't have data for aerospace for quite a few countries, so I've used the other transport equipment group rather than the detail of aerospace, although I will talk a bit about aerospace in a moment. You can see here, by far the worst hit industry, of course, was the automotive industry. Large parts of it across most of Europe were actually shut in April and in May. Some reopening, but 1.5 months at least of virtual closure. So not surprising perhaps that the index was as high as it was, and much worse than in again, comparing back to the financial crisis. Much lower level of output from the automotive industry than there was in 2009, end of 2008, beginning of 2009. For the other industries, machinery and metal products, the red and the orange lines on this chart, you can see that output only fell to the sorts of levels we saw in the financial crisis. And indeed, for those two industries, the fall was smaller than in the financial crisis because it didn't start at such a high level. You can see back in 2008, very high levels of output in metal products and machinery, and it wasn't that high in 2019. Close to it, but not that high, so a smaller fall. We do see a much more marked fall in the other transport equipment industries, but again, only to about the sorts of levels that we saw in the previous financial crisis, and that's really a function of what's going on in those individual industries. So we'll take a look at those, and I'm going to start obviously with the automotive industry. There is a recovery in the automotive industry, but it's still a long way from being declared complete. This chart tracks on a monthly basis vehicle sales, light vehicle sales. They are cars in most countries. The Americans have a somewhat different view of what constitutes a car, but nonetheless, this is the data that we have for the US that's most comparable. You can see here that one or two areas, Eastern Europe, car sales have got back above where they were at the end of 2019. Indeed, they didn't fall for a couple of months in Eastern Europe, which is the light blue line. You see the very sharp fall in vehicle sales in China. China is back above that level, that end of 2019 level, but it's not by no means not made up the gap that we saw early in the year. That will take a while to do. Western Europe car sales recovered, fell eventually by nearly as much as they did in China, but have recovered, but then fallen back again over the last couple of months, September, October, as some of the restrictions on activity in the economy were reintroduced. So these two charts look at car registrations, effectively car sales. If you buy a car, you have to register it in most countries. On the left-hand chart, we compare globally, if you like. And Western Europe really stands out as which is the yellow line on the left-hand chart, really stands out as having the largest fall, although that is partly a function of the fact that it was strongest at the end of 2019. So these are percentage changes compared to a year earlier. So it's slightly misleading that Western Europe has the strongest fall, but if you look at the overall span of that decline, it is the largest. Although it's recovering relatively strongly, certainly compared to the US and to some extent to Japan. China had the crisis a little bit earlier, and you can see there the recovery that we saw in the previous chart. If we look at the right-hand chart, this takes the four of the biggest car markets in Europe. And you can see here they're all affected pretty similarly. Germany a bit less so than France, UK and Italy. But again, also, if you look at the end of 2019, just before the current crisis hit, you can see the UK, in fact, car sales were not growing in the UK. They were falling a little bit, not much. So the UK is kind of out of step again with the other major European countries before the crisis hit. And then looking at output in those two industries, we've got charts here for Germany and Italy, which are two obviously of the major automotive producers. Again, you can see orders have recovered pretty strongly. And indeed, in both Germany and Italy, they're above where they were now before the crisis struck. Orders, which is the sort of the bluey grey line on these charts. But there may be an element of bounce in that, in trying to catch up with activity in those orders. So probably expect to see the orders level tail off. Despite that growth in orders, even in Italy, where the recovery in output, the red line, has been stronger than in Germany, it's really not yet back to the sorts of levels we saw before the crisis struck. And in Germany, it's quite a long way from that, and looks as though we might be tailing off in Germany, which is a bit of a worry, given the importance of the German automotive industry to not just the automotive industry across Europe, but to industrial output and industrial activity generally. Apologies. Aerospace has really met its perfect storm, if you like, in COVID-19. We've seen a collapse in global air travel, and it's going to take a while for output to recover. On top of which, those companies that were involved in Boeing, obviously well-known problems about the 737 MAX. You can see here the massive fall in global passenger traffic. Of course, it's not actually possible for it to fall by more than 100%. So the y-axis on this chart is a little bit odd. I think it only went below minus 100 simply because the EU line would almost have fallen off the bottom of the chart. And you can see really not a lot of recovery going on. Global passenger traffic, although it's recovering, is still way below where it was a year earlier. And it won't be until we start to get to January, February of 2021 that we'll start to see that recovering. And this is deliveries of aircraft by Airbus and Boeing. This is unit numbers of aircraft. Inevitably, Airbus has delivered fewer aircraft. But you can see the impact of the problems with the Boeing 737 MAX. And I suspect, in the case of Boeing, that they may well have still been counting some of those aircraft that they were building but not delivering to anybody. The single aisle aircraft, the 737 and the A320 series, are, in unit number terms, indeed also by value actually, but in unit number terms, by far the largest part of the aircraft output. Although obviously the wide body aircraft are much higher in value, the aircraft companies make far fewer of those than they do the single aisle aircraft. And so here we see again the recovery tracker for aerospace. Much more gloomy picture than you see than we saw even for automotive industry. And the automotive industry wasn't great, but none of the lines here are anywhere near getting back to where they were before the crisis hit. Interestingly, the UK actually saw aerospace output increasing the first couple of months of 2020 before falling away. But that's some very odd things going on in the UK's statistics in terms of the aerospace industry. But as you can see, Japan's the closest to getting back to the pre-crisis levels. Canada looks as though it's heading that way, but still significantly weak in the EU and the UK, and USA struggling to recover. The US data will go a bit mad, I think, when Boeing starts delivering all its 737 aircraft, assuming that the rest of the world joins the USA and allowing them to fly again. But it's kind of a known unknown, to use a previous American vice president's phrase on that one. And looking at the engineering and metal products industry, and apologies, these next 2 or 3 charts flit around a bit in exactly what they cover. So again, comparing what happened in globally, you can see again Western Europe, which is the red line on this on the left-hand chart, hit harder and indeed earlier than both either the US or Japan. US in this example, not as bad and recovering a bit more quickly as well than than for Europe and particularly Japan. Japan looking quite anemic in its recovery. And again, looking at the 4 big European countries on the right-hand chart, you can see similar experiences in Italy and France, and indeed the UK, although the UK fell from a lower level before the crisis. But equally the UK not recovering as well as France and Italy. And Germany here quite a bit different from the rest of the other 3 countries. Yes, obviously output fell across the whole of engineering and metal goods, but it didn't fall as far as it did as the other countries. Although having said that, it doesn't yet show any sign really of recovery in output in Germany. And again, that's just a note of concern, I guess, around the prospects for particularly for our industry in selling to that as a customer industry over the next year or 2. And again here, the recovery tracker, looking at what's going on, you can see really only China and Korea. Korea seems to be a bit of a star in this, not quite sure why, but it's the only country where output in this industry is well above where it was before the COVID crisis hit. China's also seen some growth, didn't see much of an impact either in terms of the impact of COVID. That's partly a reflection of the way China's policy worked. Most economies around the world look to support the consumer in their economies. Chinese approach was very much to boost investment and to boost industrial activity and allow that to feed through to the consumer. So that part is a part of the reason why in this particular industry you don't see the downturn in China. But the rest of the world still struggling to get back to the sorts of levels we saw before the coronavirus hit, let alone seeing any sort of recovery that takes you back above into growth, if you like. And again, I've got three countries here just to illustrate the different examples of what's going on. And these, as you can see, we don't include metal products. So we've got electrical machinery, which is the red line on each chart, and then machinery, mechanical engineering, which is the blue lines on the charts. And you can see contrasting activities. The French data is turnover, whereas Germany and Italy is orders, but nonetheless, you don't get turnover if you don't get orders. So it gives an impression of what's going on. Again, you can see in Italy, new orders back to pre-crisis levels. Those pre-crisis levels weren't necessarily that brilliant, but nonetheless, they were positive and back to those sorts of levels in Italy. Germany, not so. Although there is some recovery in this data, it's the metal products data in Germany that's particularly weak. But nonetheless, still a long way from getting back to pre-crisis levels. And France, somewhere in between. So France seeing quite a strong recovery, but not yet back to the pre-crisis levels, but not as far from them as Germany was. I'm just going to take a moment out here to talk for a little bit about the UK and talk about Brexit. We still don't know what's going to happen. We still don't know whether there's going to be a deal or a no deal in terms of a trade deal with the European Union. the sense is that things are going to come to a head over the next 2 or 3 days, probably one way or the other. But the UK really has, in terms of economic terms, has already made its decisions in terms of leaving the customs union and the single market, and we're left really with the choice between a deal and a no deal, which are really the two worst options that we could have come to, having decided to leave the Union. This was a chart that was compiled at the time of the referendum back in 2016, and showed 9 possible ways that the UK might end up leaving the European Union. And as you can see, we are now at the point where the choice is essentially between the worst 2 options. And so, people say, well, there's only 1% difference in terms of impact on the economy between having a deal and not having a deal. That's true, but having a deal really isn't a great idea, given the way we've done it. The bad news is baked in, if you like, to use the oven terminology that our Prime Minister seems to be so fond of. And this is why, in many ways, if we have a free trade agreement, there will be customs costs involved, which will affect UK manufacturers, and some other non-tariff barriers, mainly in services, but a little bit in terms of goods, in terms of regulatory changes in regulations. That's really where those non-tariff barriers come from. If we don't have a trade deal, the customs impact is the same, a little bit of an increase for goods in terms of non-tariff barriers, and then on top of that, costs from tariffs which will be imposed on UK exports to the European Union. And you can see here where the tariff and non-tariff barriers come from, or the customs and the non-tariff barriers come from, rather. And you can see affected by regulatory change, like chemicals and food and drink, which are at the bottom 2 bars on this particular chart. They're the most exposed to changes in regulations. Industries like machinery and aerospace and motor vehicles aren't going to be affected, at least initially, by changes in regulations, particularly. So that issue does depend a little bit on which industries you're looking at. And Brexit will inevitably weaken the economic recovery in the UK. You can see there's not a lot of difference between having a free trade agreement with the EU and not having one. Clearly, it's better to have one than not, but nonetheless, not a lot of difference. But it does hold back the manufacturing recovery. So this is a monthly forecast of UK GDP growth through to the end of 2021. And you can see that while industrial production, which does include things like oil and gas extraction and utilities as well as manufacturing, but nonetheless illustrates the point, you can see that while actually it's done slightly better in the recovery so far than services and obviously the whole economy have, that really gets choked off if we don't have a trade deal. And even gets choked off if we do have a trade deal, and so you won't see that continual improvement that we're likely to see in the service sector repeated in manufacturing because of Brexit. The next set of charts, which really bring this presentation to a conclusion, I'm not going to say a lot about them, simply because it will get a little bit monotonous, and I'm not necessarily an expert in all the individual countries. But just to run you through what these charts show, obviously when you get the presentation you can have a look at these in detail, look at your country and maybe compare with other important markets that you might have. I'm going to, obviously Austria, or at least in English language, Austria comes first. And apologies, my dog is barking in the background. you can see what this set of charts will show you. So on the left-hand side for each country, we have a chart that shows GDP, inflation and the unemployment rate, data, so solid lines up to 2019, and then forecasts in almost all cases from the European Commission. So the European Commission publishes an economic forecast 2 or 3 times a year, and I've taken the latest of those, which was from October, and taken the forecast for GDP, inflation and unemployment for both 2020 and 2021 and put those on those charts. Now, you may well have different forecasts within your country. Indeed, it's often said that when 2 or 3 economists are gathered together, you'll get at least half a dozen opinions. So for your own individual country, you may have other forecasters that you prefer to use. I've used the European Commission because it does give a consistent view for all of the countries that we're showing. So at least you get a comparable picture, if you like. And then the right-hand set of charts are the output index for our 4 key industries. There are 1 or 2 countries where we don't have all that data, but most of them we do. And in this case, the 2020 figure, which is shown by the dotted line, is the average of the first 3 quarters of the year. So it's not a forecast in the sense that it's not where we expect 2020 as a year to end up. It's where we've got to across the first 3 quarters of the year. I'll go through these, give you a chance to at least view them. I'm not going to say a lot about the individual countries. I will pick out 1 or 2. Inevitably, you see a similar picture across most of these charts. You see a sharp fall in GDP, particularly in 2020. You see a bounce in 2021. Bear in mind that the left-hand charts are percentage changes year on year, whereas the right-hand charts are measuring levels. One thing I do want to just pick out is what's happening to unemployment across various countries, because it's an illustration of how the policy of particular governments can affect what's going on. So, for example, in Belgium, we see unemployment rising in 2020 and expected to rise again in 2021. Similarly, in Finland, and Finland's one of those countries where we don't have data for all the sectors on the right-hand side. Particularly, I'm fortunate about other transport because Finland's quite interesting because it has a big shipbuilding industry, but nonetheless, we don't have any data for it. In France, however, you can see that unemployment is forecast to be level in 2020. France is one of those countries that's put a lot of effort into maintaining jobs, supporting employers to keep people in jobs. I won't say necessarily in work, but nonetheless in jobs, and therefore not unemployed. But if you expect those measures to unwind in 2021, clearly the European Commission have taken a view in the case of France that unemployment is likely to rise in 2021 as those measures get eased off. You can't go on doing this sort of thing forever, and therefore the people who are effectively not working but nonetheless being paid then become unemployed, and so unemployment rate rises. It's an illustration, if you like, of how policy can affect some of this data. Similarly, in Italy, you're not allowed to make people redundant, so therefore actually unemployment is expected to fall. The unemployment rate is actually expected to fall in 2020. Not a lot, but fractionally. But then you see a pickup in 2021 as the policy unwinds and people get made redundant. Quite a strong growth in the Netherlands, although it's slightly misleading. Just bear in mind when you're looking at these, the various scales do change between individual countries. So actually, the movement in the Netherlands isn't quite as dramatic as you might expect. If you just look at 2 charts next to each other, Spain's another country where unemployment is expected to increase in 2020. Here, although the government has been supporting people in jobs to some extent, the tourism industry obviously is very important in Spain, and therefore you see the impact really through that particular industry on unemployment in Spain. I mean, just for a moment, going back to the right-hand charts in all of these, you'll have noticed that that output was falling in 2020 in all of these countries. So although most of them will have seen a recovery in the third quarter of the year, it's really the impact of what happened in the second that reduces that overall index. Switzerland, you see again what looks like quite a strong rise in unemployment in the left-hand chart, but Switzerland actually has the smallest range on the y-axis, the vertical axis of the left-hand chart. So that's a little bit misleading in this particular case. Turkey, again, Turkey is a country where policy is affecting the forecast for the unemployment rate, and indeed some of the other factors as well. And also Turkey's in a slightly different position in the cycle. And then to complete the countries that are members of CELIMO, at least this is the charts for the UK. Again, you can see the very sharp fall in automotive output on the right-hand chart. And then to cover the other European countries that we look at, Germany, interestingly, the expectation is that unemployment will rise in 2020, but then flatten off in 21. Slightly unusual impact. Not probably sure what lies behind that, but strikes me as a little bit odd, perhaps. Czech Republic, Hungary, Poland. Again, Poland, a country where we don't see a lot of change in unemployment rate in the forecast. And finally, Sweden. Sweden, which had a different approach, if you like, to many other countries to the crisis. You could see unemployment rising much more sharply in 2020. Just one point to make about Sweden and its industries. The automotive industry in Sweden is very much trucks. There's some car output, but it's dominated much more than any other country, even Germany, dominated by truck output. And so you do see a bit of a different picture in terms of what's happening in the Swedish automotive industry, or Swedish motor vehicles industry. Yes, it's obviously down sharply in 2020, but not on the same sort of levels, if you like, as we saw in most of the other countries. That concludes the presentation. I'm going to take it off the screen. Just bear with me a moment. I need to get rid of it. Hopefully you found that useful. I'm just going to see if there are any questions in the chat. I can't see any questions. If anybody has any, perhaps you'd like to unmute yourself or put your hand up, might be useful. You'll find the little hand in the options, which on my screen, at least on the top right hand side of the screen, hopefully they are for you as well. Or if anybody's got any questions, I'm happy to try and answer them.
Hi, Jeff.
Hello, Adal. Anything?
Yes. If there is no question, I just want to say some words to the members. Okay. Dear board members and association members, first of all, thank you very much for your participation to this event. Your participations are very important and valuable for us to be able to improve the CELIMO digital activities. You know, we have a difficult time, pandemic, because of this pandemic situation. As we CELIMO organize this event, and we will continue to organize this kind of digital events in the future. And as CELIMO, we will continue to be an even more important source of information for the sector. If you need any additional information, you can ask from your local associations. And I would like to healthy and safe days for all of you, your families, and your company members. Thank you very much for your participation.
Thank you, Erdal. I will send around as promised, I will send around the presentation in a few minutes after the end of this meeting. We don't have complete participation list, so we will send it to the associations and to the board members, people who I have a contact for. So if you are on this meeting and don't receive it, please contact your association in your country, who will be able to send you the presentation. And similarly, I will store the recording, and as soon as we're able to get it loaded, probably onto YouTube, we'll circulate a link for you to be able to go and view the presentation if you like as well, if there's anything I said that you wanted to pick up on. Just a moment in case anybody's got any questions that's occurred to you. I can't see any activity. So I think with that, I will stop the recording. Wish you a good day. Hope you have a good weekend. And hopefully at some point in 2021, while we'll continue these presentations, hopefully we might be able to meet face to face at some point next year. Thank you.